Aloha, everyone. Thank you for joining us. On behalf of the Hawaii Economic Association, I welcome you all to today's webinar. I am Mary Awong, and I'm the Association Support Consultant contracted by HEA. We're happy to have you with us today. We'll be having a great discussion with Paul Brewbaker, Stephen Rodgers, and Byron Gangnes. Before we start, there will be a Q&A session toward the end, so please enter your questions in the Q&A area. And as you can see on screen, there is a menu bar at the bottom with Q&A, and please feel free to enter your questions there. Paul, our moderator, will be filtering through those questions and prompting them at the end. Also, if you are not an HEA member yet, please consider becoming a member today. So without further ado, I would like to introduce Paul Brewbaker, our moderator for today. Paul?
Aloha, Mary, and howdy from the Lazy Brewview Ranch in Boulder, Colorado. We're celebrating the availability of this technology, which I had to learn from Sarah Brewer. You remember 4 years ago when she was helping HEA, and it's a brave new world. I'm delighted to have a couple of really good friends join me today to present on various aspects of the macro questions we thought we'd discuss. But first, I did want to make a pitch for to both membership and attendees to this virtual presentation. The idea behind which was partly to raise some money for the HEA Scholarship Fund. I'd like to encourage you to consider contributing additional amounts. This was a very low-cost event. We appreciate that the technology makes that available, and maybe it will aid in your generosity towards supporting undergraduate and graduate students at UH, and maybe we should think about some of the other campuses around town as well. I also want to thank Leslie Harvey as well as Mary for putting this together. I had this crazy idea after the National Association for Business Economics policy meeting in February that we should get on the internet shortly thereafter. And now a month's gone by and I can't remember what was going on at the meeting. But I did see Byron Gangnes there, and I immediately said to him, dude, we should get together and do a webinar like this. So here we are. I would like to therefore go ahead and I just want to, sorry, one more thing. Just a shout out to my mentor, Dave Ramser, who's the guy who hired me into Bank of Hawaii back in the day. You'll see in a minute that the Bank of Hawaii roots run deep in today's presentation, but he was thinking he might be able to join us from Dallas, and I appreciate that as well. And I'm sure many of the 100 or so of you who have joined us have crossed paths with me over the years, and for that I'm really grateful. And actually, I'll be back in Hawaii one of these days, and so we can hang out. Our guests today are an academic and then a practitioner. You've got bios in front of you from your HEA announcement, but Byron Gangnes is Emeritus Professor of Macroeconomics and International Economics and a bunch of stuff at UH Manoa. Spent his career there, retired recently to the city of Santa Fe, where maybe he's going to take up painting or something. But no, actually, Byron's the only guy I systematically have seen at the National Association for Business Economics policy meetings in February or March each year. And so, as I say, when I ran into him last month, I thought, hey, let's get together and talk about this. We're at a really important moment in terms of monetary policy transition, movement towards what the Fed calls normalization, in addition to the political economic environment, which we won't have as much to say about, I imagine. Our other guest speaker today, Steve Rodgers, joined me when I was migrating from the economics function of Bank of Hawaii to join the finance team. Steve was a young MBA smart kid who a UH MBA who joined the team and is now the chief investment officer, I believe, at First Hawaiian Bank, a role he also played at Bank of Hawaii when he ran the bond funds and whatnot for the what the old Hawaiian Trust Company that actually moved into the commercial bank after Glass-Steagall was dismantled. So a seasoned professional, as I say, executive vice president and chief investment officer, recently returned to Hawaii at First Hawaiian Bank, along with emeritus professor Byron Gangnes from UH Manoa. And I think we're going to start with Byron's short presentation, and then we'll segue just a little. I'll set you up, Steve, and then I'll cut you loose on Fed policy, and then we'll see where the conversation goes. Have at it,
Okay.
Byron.
All right. I assume you can hear me?
You bet.
Well, hola from New Mexico. It's nice to be back with you in Hawaii. Here, spring has sprung. We have flowering fruit trees, but it's still chilly, so I'm wearing a sweater here and not an aloha shirt. Since Paul is in Colorado and I'm just a little bit south of there, we thought maybe we should just bring all of you guys to New Mexico, but the budget didn't cover that. So you have to stay where you are and listen to us instead. What I'm going to do is give a brief, somewhat selective overview of U.S. macro conditions to set the stage for our discussion. As you know, we are in the midst of a contractionary Federal Reserve interest rate cycle. The Fed has raised rates sharply, starting almost exactly 2 years ago. And rates today are about a little over 5% higher than they were back in February 2022. Particularly rapid rate of increase, and of course, much higher rates now. The higher interest rates are designed specifically to slow borrowing and spending, right? And therefore to reduce inflationary pressure. That's how the Federal Reserve works to try to keep the economy on track. In this case, of course, to fight the inflation that picked up in the early recovery period. So the real question sort of is, where do we stand now as we are looking not at the prospect of further rate hikes, but in fact anticipating when is that first rate cut going to come? And that's something I know we're going to discuss throughout the hour today. I think it's useful to remember where we started. If you go back to, oops, I can't see it. If you go back to early 2021, after a period of very weak price increases, we had just a soar in inflation rates, and they peaked in about the middle of 2022. And as you know, they've come down significantly since that time. And I'm going to, at the end of my little talk here, talk a little bit about where we stand today on inflation success. Inflation fighting success. But this very rapid increase in inflation caused the Fed to have to think hard about how to respond and how to get inflation under control. There's more than one reason that we had that big increase in inflation rates. And so I want to remind you of the things that were going on at that time. If you look at this left-hand chart, it shows the wait time for chips deliveries, right? So this is computer chips. They're used in all kinds of things. Importantly, they're used in modern automobiles. And the auto industry was hit very hard by the time it was taking to get the chips they needed to proceed with auto production. So we had, on the supply side, we had these kinds of delays in the delivery of key components. We also had a huge increase in shipping costs and shipping times. And so we had these supply side constraints that were driving up costs, and that was feeding through into inflation. We also had a slow return of workers to the labor force. And so it became very difficult to get the workers you wanted, even if you were ready to expand in that year after the pandemic. The right-hand graph shows actual and predicted U.S. saving. And the point here is that I want to talk about the demand side. So on the demand side, once the pandemic was more or less under control, there was this huge pent-up demand, especially for services, things like eating out at restaurants, traveling, all that sort of stuff. And so there was this tendency for demand to pick up strongly. And it was facilitated in part by very significant federal fiscal supports. And those three spikes that you see in that graph on the right are actually increases in income that households were getting from the federal programs. There were three programs that were important. And so there was, so during the pandemic period, the support that had been given to households to keep them whole, to allow them to continue to have food on the table when they didn't have the ability to go to work. That meant that after the pandemic began to wane, households had a tremendous amount of savings built up. And this excess savings allowed them to spend at a very robust rate over the last year and a half. So that's the background in terms of thinking about where inflation came from and the fact that it really had to do both with problems on the supply side as well as robust post-pandemic spending. So those are the forces that were pushing up inflation rapidly in 2001 and 2002. From the start, the Fed had the notion that it should be able to achieve what it called a soft landing, okay? And that means, reducing inflationary pressure, getting inflation back to the levels that it would like to see over the long run without causing a recession, an outright decline in economic activity. And there's some reasons why that was a reasonable thing to try to do. One is that the Fed and the rest of us realized that some of the factors that were driving up inflation were transitory, right? And so, for instance, as the supply chain problems gradually got better, then the problems of supply side constraints pushing up costs began to ease, right? And the transitory increase in federal income supports was a temporary policy. And so eventually those resources would begin to dwindle. And so that would begin to pull back on demand. And so the Fed had this idea, look, this time around, if we're lucky, we should be able to get inflation down without having to cause an outright recession. And so far, that's what's happened, okay? Substantial progress has been made. You saw that inflation picture and you've seen it before. But it's not vanquished yet. And I'll come back to that in a couple minutes. And what I want to do is I want to talk about three aspects that I think are key to whether or not the Fed is going to be able to achieve the soft landing that it's looking for. Labor markets. So I mentioned that it took a while to get people back into the labor force. Today, labor force participation rate among prime age workers is actually at all-time high, but it took a long time to get there. And as demand picked up and companies began to look to expand business, we had a really tight labor market. And this was something that Federal Reserve Chair Powell talked about a lot, the problem of having excess demand for workers and the concern that that would drive up wages and costs and cause inflation to persist. These are a selection of some major industries, the job opening rates relative to January 2020. Okay, so they're all starting there. I've made them into an index starting at 100 for each of these. And as you can see, the job openings rates went way up by middle of 2021. They remained high for the next year, but then they've come down a lot since then. This is one place one indicator of labor market behavior where we've seen a softening of labor market conditions in the sense that the severe excess demand for workers has gradually receded. For Hawaii, one interesting one there is leisure and hospitality. That's the purple line. And you can see that there was a huge shortage of workers in leisure and hospitality during that period of extremely tight labor markets. But now we're more or less back to normal rates of job openings. And so this is one picture that shows one aspect of labor markets where we are seeing the kind of progress we really need to see if we're going to have wages stabilize and we're going to have inflation stabilize. Other aspects of the labor market that are important. Job growth. Each month we get, 100,000, 200,000, 300,000, whatever, new jobs created. That has also fallen off, although it remains higher than the sustainable rate of growth of jobs for the U.S. economy. Interestingly, immigrants have been very important over the last year in filling jobs that where we don't have enough domestic labor force. In fact, nearly all of the growth in the labor force over the last 6 months or so has come from immigrant labor. And that's allowed the economy to continue to grow, even though we're more or less fully employing the domestic labor force. What else here? Unemployment has remained very low, but it has ticked up a bit, which is good news. We need to have somewhat more slack in the labor market to allow wages to stabilize. And so along a number of dimensions, the labor force has begun to return to normal, where we don't have shortages of workers. We don't have, therefore, we shouldn't have a lot of upward pressure on labor costs. Where we have a problem still, I think, is in overall economic growth and the demand for goods and services. So this is a graph showing real personal consumption spending, year-over-year growth. The top line is the red line, right? And so if you look at that, you can see that, of course, we had very rapid rates of personal consumption growth during 2021 in the post-pandemic rebound period, and then growth slowed a bit, and then it picked up in 2023, both for goods and for services. We've had the economy overall has been growing at a very robust pace. Second half of the year was particularly strong. So in the third quarter, for instance, real gross domestic product expanded at almost a 5% pace, and in the fourth quarter, a better than 3% pace. Those are not sustainable rates of growth of real GDP, and they're driven in large part by robust consumer spending growth in the latter part of the year. That has to slow in order for inflationary pressures to ease. I think there are good reasons to think that it will slow. In particular, we talked about those excess savings that were built up during the pandemic. Those are gone. They were gone earlier for families of lower income, and they're probably gone now for almost all families. And so that pool of money that was built up during the pandemic is no longer there. There are other things that are going to weigh on consumer spending. One is that the labor market is gradually cooling, and as it does, that underpinning of confidence in job stability, job security will begin to ease. And of course, the costs of financing short-term borrowing have gone up a lot. It turns out that households overall, their overall debt burden being borne by American households is not historically high. And that's because lots of households locked in very low interest rate mortgages. However, the short-term borrowing rates, of course, have gone up, they've skyrocketed. And so the cost of financing credit card debt, auto debt, other things like that have gone up quite a bit. And my guess is that bears most heavily on lower and lower middle income families, not upper income families. Look at the very last observation in this graph. That's January. In January, we saw a drop-off in consumer spending growth to about 2%. I hope that's what we're going to see for February when we get the data tomorrow. We need to be at 2% and not higher than 2% probably in order to get demand to come in line with supply and not to contribute to further inflationary pressures. Yeah, okay, fine. Circling things. Okay, now let's look at inflation itself. We have had a lot of progress fighting inflation. And if you remember in that first graph, I'm going to jump back to it for a second because that's easy. If you look at this first graph, we tend to look at two different measures of inflation. You have the consumer price index that we're all familiar with. You have the personal consumption expenditure deflator. Both of those have come way down, but they remain above the Fed's long-run target. And in particular, there's some particular sources, as I jump forward again, there are some contributors to inflation that remain very worrisome. And so I want to talk about that a little bit. This graph looks not at year-on-year inflation, which was that first one, but it looks at personal consumption expenditure inflation over 6-month periods, and then annualized, so that you can think of them as annual growth rates. But the idea is I want to look at not what's been happening over the last 12 months, but what have we seen recently? And is that indicating that we're seeing a continued fall off in inflation or not? And the answer is, as you can see in the graph, not, okay? If you look at the last 4 months, in particular, the 6-month inflation leading up to that month on an annualized basis, has been running at, what is that? I can't even read this, 2.5% or something like that. It has not continued to fall off. In fact, it seems to be kind of stuck in that range of 2.5% to 3%. And there are two reasons for that. If you look at this graph, there's 4 different components that I've constructed, okay? One is, blue is energy, goods, and services. Energy prices were rising in 2020, 21, and the beginning of 2022, and so that was contributing to inflation. That's gone now, right? We've had some ups and downs in gas prices, but we're not getting inflationary impulse coming from energy prices. Goods prices are even more dramatic. That's the green area. So this is physical goods other than energy. And you can see that, again, they were making a big contribution to inflation in 2021, 22, and now we've actually had declines in non-energy goods prices in recent months. So what does that leave? Well, it leaves the 2 areas of concern. One is housing, right? As you probably know, shelter costs have not fallen off as rapidly as most of us had expected. And so we have that contribution in that orange area, about 1%. Coming from shelter costs. The big concern to me, though, is the red area. The red area is all the services that we consume other than energy services and housing, okay? So this is eating out, this is taking trips, this is all those non-tangible things that we consume. And as you can see, that's the part that really hasn't shown much sign of improvement for the last 6-7 months. And this is the area we're watching very closely because the Fed watches the personal consumption expenditure inflation measure that I'm looking at here very closely as its indicator of whether or not inflation is coming under control. In the last few meetings, Chairman Powell has said, well, we need to see a few more months of good results before we start to, look at the possibility of cutting. If they're looking at this graph, they're going to be waiting. And so again, we get data on this tomorrow. Hopefully what we'll see is a downtick and a movement toward further gains in stabilizing inflation at that 2% goal that the Fed has for the long term. So to me, this is a very mixed macro bag. Okay, we've got some good news in the labor market. It's much improved in the sense of being not as tight, not as hard to get workers, not having these shortages that might bid up wages rapidly. On the spending side, we have seen some moderation of spending, but the end of the year, of course, was very strong. That needs to soften a bit more if we're going to have continued price stability. And then here is this issue of, an important component of what we spend our money on simply is not showing the continued decrease in inflation that we might like to see. So I'm going to stop here. What do the prospects look like for Fed cuts? Well, I know that's something that Steve is going to look at and we can talk more about in our discussion later. Thanks very much.
Thank you, Byron. Yeah, let's move on to consider monetary policy just a little to build a bridge to our comments from Steve. Let me just pick up where Byron left off with the Hawaii inflation data for anybody that hasn't been keeping track. And by the way, I have not updated the last observation here, so this is through year end. Hawaii consumer price inflation, not the PCE deflator measure that Byron was using and that the Fed targets at 2%. The CPI, the urban Hawaii CPI measure for the post-pandemic recovery period, was running a little cooler, just a little bit below the national average, which you see in the dashed blue line here. But as Byron suggested, in more recent months, despite having come down nice and right into the zone, the Hawaii measure at the end of last year, there's still some stickiness there. It's in these non-housing and non-energy services that are a little, are we measuring that right? Do we know what that is? Are people changing their behavior? A lot of questions associated with that. And just a reminder with this graphic, the CPI measure inflation tends to run about a half percentage point higher than the PCE deflator measure. So if the Fed's goal is 2%, you'd expect to see a CPI in equilibrium or in a consistent configuration with the Fed's target, a little closer to 2.5%. In terms of decomposition, I'll just complement something that Byron raised. If you go to the Federal Reserve Bank of San Francisco website, they have this interesting new data set that breaks down. If you think of the aggregate supply curve and the aggregate demand curve, and you have supply shocks, demand shocks, how much each of them contribute to the inflation, not unlike the decomposition Byron showed you with the PCE deflator. You can think about which part of the aggregate demand, aggregate supply universe is operating. And of course, the supply shocks post-pandemic were quite substantial. At the same time that federal fiscal stimuli had created this demand wave that is dissipating, but kind of not fast enough, at least for some people's taste. And as a result, to set up Steve, interest rates rose more in the last 3 or 4 years. Oh, I'll put it this way, half the population of Hawaii has never lived at a time when the Fed funds rate went up 550 basis points. Let me say that again. Nobody under the age of 40 has ever experienced what interest rates did in the last several years. And of course, it's not just, in this case, you'll see the dotted line there, the 10-year note, a benchmark, the risk-free long-term benchmark, but the mortgage rates that ride on top of that with not just a risk premium that's idiosyncratic to mortgage lending or as a housing and investment as an asset class, but an additional systemic risk premium. I don't know. Some of us been talking about this for a while. That blue line at the bottom, it's not just that the term structure of interest rates went up, it's that the spread to the term structure widened out dramatically in the last few years. And as a result, when those mortgage rates go up, and here I've inverted the rates, but just to illustrate, when mortgage rates go up, which is down here in the red dash line, then home sales go down. So everybody in the housing market is waiting for the Fed to come through with the promised change in or the anticipated change in policy, normalization of interest rates, for which they've been providing extensive forward guidance. And maybe now, Steve, if you will, let's see what you have to share with us. I have Steve's slides because he's on his phone and we're totally hacking the presentation here so here to introduce.
Well, while you're doing that, I'll just say thank you, Paul. Thanks for having me. It's great to reconnect with you, with Byron as well as with the Hawaii Economic Association. It's nice to be back home here after about 5.5 years away in Europe. And I recall attending a few of the HEA events in the past, and so I'm happy to be back and attending again in this capacity, and hopefully attend some in-person events as well. So looking forward to that. I think we got a decent amount of overlap in the HEA membership as well as our CFA Society Hawaii membership, which we just had our annual forecast dinner a few weeks ago. So covered some of this information. One of the things I thought it'd be interesting to talk about, as we talk about the financial markets. I mean, there's lots of macroeconomic data out there that, Byron and Paul did a great job of illustrating, and there's, lots of smart people out there looking at all of this macroeconomic data. The major conduit through how all of that information gets sort of passed on to the financial markets is really through the Fed funds rate. And so I thought it'd be interesting to take a couple moments to look a little bit about the Fed funds rate and the forecasts and historic forecasts for the Fed funds rate as well as where we stand today. And so if you can move over to this slide, which looking at it is not intuitively gives you an immediately obvious picture. So I'll take a couple moments to just walk through what is really on this chart. And I got to say, I'm also happy to be here at First Hawaiian Bank, and a great team here has helped me pull together this data. So this is a function actually on Bloomberg called DOT, and it's got a both forward-looking function as well as a historic-looking function. What this shows is what were the FOMC members projecting for the Fed funds rate at the end of 2024 at a certain point in time in history. So to sort of walk through that again, so the very first set of dots, the dot plot, as of September 2021, what were the FOMC members anticipating was going to be the Fed funds rate at the end of 2024, the end of this year. So 3 years ago, what were they thinking, what might be the end rate for Fed funds? Remember, at that time, we were still at zero. So Fed funds rate hadn't started going up yet, but there was expectations that that rates were going to be going up soon. Then the question was, okay, 3 years from now, where's that endpoint going to be? And so that's what that first distribution shows. Oftentimes, because a chart like this gets very messy, oftentimes it sort of the quick and easy method is to focus on the median, which is the green line. And so the median, as of September 21, that first clump of dots vertically, was what was the anticipated, the median rate, which was expected to be a little less than 2%. So 3 years ago, they thought, okay, end of 2024, Fed funds might be around 175. We are now, we're 525 to 550. So that wasn't even contemplated, certainly not as the median, nor even the range of distribution of those FOMC members. So that first 3 years ago, and look, this is hard, right? I think Byron did a great job of saying all the different types of input that the Fed is looking at and trying to anticipate what's going to happen to inflation, what's going to happen to the economy, and their two mandates, which are trying to maximize full employment and keep prices stable. But even among the folks who are voting on where the rate's going to be, there's quite a wide range of dispersion. So to me, the dispersion is actually really interesting to look at. So I won't go over every single meeting date on this chart, other than to say, so then the next date, at the December 2021, you can see the dispersion starts coming in a little bit closer as there becomes a consensus view that, okay, rates are going to be going up. We're not quite sure at what point we're going to need to start tapering off rates, or how quickly we're going to need to start raising rates. Certainly at that time, nobody was contemplating, even an outlier wasn't even contemplating, hey, inflation might get out of control and we're going to need to raise rates up to 5%. And so as we move through time, we get closer and closer to present day. But as you can see, as inflation continued to increase, the rate expectations continued to increase. One of the interesting other points is the year after, in September 2022 and December 2022, that dispersion starts to widen out quite widely. And again, that's just an indicator to me of the range of where inflationary pressures may go, where the economy may go. And, let's remember, we were coming out of a global pandemic, which, there's no playbook written for that. And, you could also argue we're not done with the pandemic, but certainly the bulk of it is behind us. And so what is the correct playbook for the Fed coming out of a global pandemic? Well, other than 1918, that we haven't had a lot of those. So moving through time, we now get to the last set of dots on this chart, which gets you to kind of current day. And so there's much tighter dispersion there as to what the expectations of where rates are going to be at the end of 2024. And, it's maybe easier to anticipate what rates are going to be at the end of 2024 when you're actually in 2024 and not in September of 2021. And so you can see much tighter dispersion there, and an expectation that on average, we may see rates starting to come down this year. So if Paul, you wouldn't mind going to the next slide. So this gets us to, say, current day, or when the last Fed meeting was on March 20th. And there you can see, again, still decent amount of dispersion, but an expectation, and the median, that green line there, of Fed funds, settling in right around, and if you can't read the label there, it's a little over 4.5%. So basically, when you hear the commentary out there, expectation of 3 Fed funds rate cuts this year, this is a more complicated way of displaying that. But again, you still see some dispersion on the upper side of some of the FOMC members thinking, hey, we may not cut rates this year. And so those, what we might call outliers, if you follow along the top of that chart, there's an FOMC member saying, hey, we may not even cut rates through all of 2025. So just to walk you through this chart, the different vertical lines are the end of the various years. So the first vertical line is the end of this year, 2024. Second line is the end of 2025. And yeah, Paul, thank you for circling the outlier up there. I guess the forecasts are submitted anonymously, so you can't necessarily know with 100% accuracy which FOMC member is forecasting that we don't lower rates for all of 2024, nor all of 2025, because this is going to the end of 2025. But we haven't started lowering rates yet. Certainly the dot plot median and the consensus of the FOMC members, which again gets you to that green line, the median, does expect rates to be gradually coming down over the next few years. But again, at the end of 2025, I mean, look at that dispersion. You've got one person on the lower end thinking that, man, they may be thinking we're getting into a recession. Fed funds could get down to 250. Or the other outlier we talked about said, hey, we haven't had any Fed funds rate. We won't have any Fed funds rate cut at 550. So we'll stay basically where we are now, 525 to 550. So, and these are the folks, most of them are voting members. They're not all voting members, but these are folks that are focusing on this all the time, and they've got a very wide dispersion. So anytime we get new information that comes into the markets, and as Byron mentioned, we got tomorrow the PCE, the core deflator coming out, the market reacts dramatically if one of those data points comes out of alignment with what the median forecast is. And just for fun, since why not, sorry, Paul, if you just go back one slide, I also included what the Fed funds futures line is. There's this light blue line. So these are, what you might call, quote unquote, the market predictions as to what the market believes Fed funds rate is going to do. And so if we flip to the last slide, thank you. This is a chart that's maybe a little bit easier to follow. Brian and Eric did a great job pulling together for me. And you've got the historic Fed funds rate. And it was 2020 starts in January 2020, Fed funds rate dropped. We're right in the pandemic. It stayed at 0 for a long time, and then right after the beginning of 2022, overnight rates started going up. And these were the market participants. So again, these are not the FOMC members. These are market participants, getting futures contracts on where they think the Fed funds rate is going to go. And even that, is difficult to predict. And so we put some of the dates on the chart there on the right side. And you can see that as of the March of 2023, participants, Fed funds futures contracts were thinking, hey, we were going to top out right around 5% and then pretty quickly start dropping rates at the end of 2023 and into 2024. Well, obviously that wasn't correct. And so those Fed funds futures forecasts got updated, but it was only quite a bit later in the year. And you can see by September, and you may not be able to read all the dates on this chart, but by September of 2023, it's actually pretty close to where it is now. And the yellow dotted line is where the Fed funds futures contracts are as of March 20th, where they're thinking the Fed funds rate is going to go. But you can also see, even for market participants, as we get new data points out, those forecasts can change quite dramatically. So this is it's not easy to do, trying to forecast all of this macroeconomic data that filters in. And I say the Fed funds rate and interest rates, foreign exchange rates, stock market are really directly impacted by the overnight Fed funds rate. And with the Federal Reserve as the largest central bank, it also impacts what the other central banks are going to do. So it's a tremendous amount of influence that this overnight Fed funds rate has on really all the global financial markets, which is why it gets a lot of attention. And I'll stop there so we can have some time for questions and comments. Thank you.
Just to segue back to Byron, if I can find all the clickety-click things that let me do that. So here's a version of what Steve was talking about with the entire term structure of U.S. Treasury securities yields, as well as the overnight rate, the actual Fed funds rate, where we are now, this plateau we reached at the middle of last year, and then the median projection of the FOMC, which Steve summarized in the dot plot, and the range from the lowest to the highest in the blue shaded area. So I want to raise a couple of questions along the way here before I do that, I want to get to the question of where we end up, maybe when we start and how fast we go, and also this interesting secondary question of what happens to the Fed's balance sheet, because the Fed's really using two instruments, or three if you include forward guidance. They're manipulating the overnight rate, of course, which is kind of an anchor if you think of it at one end of the term structure of risk-free interest rates. But it's also using its ability to have a quantitative impact in the bond market where Steve's operating, and currently is allowing $95 billion in mortgage-backed securities and U.S. Treasury securities to roll off the balance sheet without replacement every month. They've been doing this now for a couple of years. They pre-announced this and they let us know what's coming. There's a whole discussion going on at the Fed, which I thought I'd segue to, but I clicked on the wrong slide. But to give you a feel for where economists think this is going to go, generally between monetary and fiscal policy, economists tend to be more favorably inclined to the approach that the Fed has in place, which is reassuring. When you ask economists, as was undertaken last month for the NABE policy meeting, when you ask economists when they think the rate declines are coming, mid-year this year seems to be where most people gravitate. Now, we've had some untoward inflation surprises in the last month or two that maybe would have changed this slightly, but something's coming and people seem to expect it. And then when you ask economists where they think we end up, you get dispersion, as Steve suggested, is present in the FOMC members' expectations, dispersion around what the neutral or the long-term equilibrium overnight rate will be. The FOMC now has a median expectation of 2.6%. You can see that the most popular numbers are, gravitate to a range of 2.5 to 2.75. But it's not just, when do we start or how fast we go, but also, where should we end up? And even some discussion about whether the Fed goal should be 2% inflation or a higher number. I'm not going to introduce that here, but maybe Byron and then Steve, could you both give a feel for what you think might be the pace, the duration, or the ending point? Pick one or two or three for the Fed funds target, and then the term structure more generally.
Okay, so I take the FOMC members' projections at face value. For a long time, the market was being much more optimistic, or maybe that's pessimistic. They thought rates would come down really hard and fast, but they're now more or less in line with what the Fed officials are saying. And so that's what I look at if I'm thinking about, look at that median, think about that's being the most likely outcome. There's you raised a separate issue about where is the Fed funds rate going to settle. And there has been a huge debate going on about what is the neutral real rate of interest. In other words, what is the inflation adjusted short-term interest rate consistent with stable long-run growth? And the estimates are all over the place, but they tend to range between 0 and 1%. So if you add 2% to that, the high end would say the Fed funds rate might settle at 3, and the low end might say the Fed funds rate would settle at 2, and the FOMC is right in the middle. So again, I think that's a reasonable thing to expect, but there's a lot of academic research going on right now trying to get a fix on where should the Fed bring that rate down to in order not to excessively stimulate the economy nor excessively drag on the economy.
Steve, what do you hear in the markets when people bring this up?
Well, I think one of the interesting commentaries, and I guess I'll, go back to some of the presenters we had at our CFA forecast dinner on March 14th. One of the interesting lines of discussion centered around that inflation may take longer to subside than everybody's anticipating. And so that, has some interesting implications that basically we could stay higher for longer if that's the case. And every inflation print that comes out that doesn't support inflation subsiding back to that 2% range would then support we stay here at this level for longer. And so that outlier we have on the chart that didn't anticipate rates going down until 2026. I'm not saying that that's a prediction. I'm just saying it's not maybe as unusual as it seems. On the flip side, all it would take is some really bad economic data. If by having rates this high for this long kind of tips the economy into recession, that could easily accelerate rates coming to the downside. There's certainly enough sort of risks brewing out there in the economy, some in the real estate arena, and so nobody's predicting a catastrophe either. But if by being at this high rate period for an extended period of time does push the economy into a recession, that could be one of the drivers for the case for the outlier to the low side. So to me, I'll let the folks that do this for a living continue to do that. You guys are both well more trained in this than I am. But again, so looking at the dispersion there, you could actually make a decent case for either one of those scenarios. So there's quite a bit of uncertainty right at this point in time.
Let me pick up on your last point, Steve, before I want to go back to Byron about the balance sheet. But here are some results from the NABE survey. Which survey is this now? they have an outlook survey. This is the business conditions survey. Sorry, they have 3 surveys. But in January, they fielded this survey, and they asked about upside and downside risks to the economy. So I've got the downside on the top, and I've got the upside on the bottom. And the way to think of this is things like geopolitical instability show up on both sides. You see what I mean? So it could be a downside risk and it could be an upside risk. And in that particular instance, I've highlighted global geopolitical instability framed by what's going on in the Gaza Strip, for example, or in Eastern Europe and elsewhere, tended to be more of a downside risk concern. And we tend to forget about these things until all of a sudden they pop up. So I'll just put that out there. The NAPE, there are public versions. By the way, I think I can make versions of our slides available to participants, and I generally will publish the public version of these surveys in the footnote if there are links there if you want to get to it. But let me come back to this question of the balance sheet, since we really didn't get to it a second ago. The Chair Powell, in the announcement that followed the FOMC meeting last week, explicitly introduced this paragraph, and this is actually verbatim from the statement, but I've broken it down into bullet points. So he noted that the balance sheet has been shrinking, and that for the first time publicly, he acknowledged that they've discussed slowing the pace of decline. They'll continue to decrease their securities holdings, but changing the pace. They didn't make any decisions, but there's a feeling that they ought to be thinking about a transition, and as to how much they continue to shrink and for how long and so on and so forth. Now, the Fed's very strong on forward guidance these days. They give us a heads up, they tell us what's coming, and then they have a bunch of PhDs at the Fed write papers about it. I was suggesting to Byron earlier in a conversation that maybe we'll see some answers to these questions at the Jackson Hole meetings in August. That's sort of customarily when they take advantage of the opportunity to roll out new research. You want to comment on this, Byron? And then Steve, let's come back to the balance sheet and how I'm particularly interested in how it's affected mortgage lending and that kind of, But Byron, you got any, what would the macro literature be saying about the monetary theory be saying about this now?
So one problem the Fed has always had is that it has very few tools. And so, it has the Fed funds rate control as its short run tool, its primary tool. And then, buying or selling long-term bonds gives it some influence over long-term interest rates. And so that's why they've begun to use this as well. If you're online, there are, of course, dyed-in-the-wool monetarist types who believe that the expansion of the balance sheet is going to lead to high long-term inflation, and then they really need to get that down fast. I don't put much credence in that. I don't think there's a magic number for how big the balance sheet should be, but they obviously want to reduce it, and it makes sense that they're going to take their time doing it. Steve, maybe you have more insight on that.
Yeah, certainly. The more visibility that's provided in a kind of structured, thoughtful way to market participants makes it the least disruptive to everybody out there. So it's very, very helpful when they go out and say, hey, we're going to be decreasing the size of our balance sheet by this amount over this period of time. Nobody's surprised. And a lot of it is just the runoff of the portfolio, and so they're just going to maybe slowing their buying as opposed to outright selling. If they just decided, tomorrow we're just going to get us back to $1 trillion, and we're just going to dump all the bonds onto the bond market, that would be bad. And they're aware of that. They're aware that would be extremely disruptive to everybody and counterproductive to what they're trying to achieve, right? One of the interesting things, and I haven't thought about it until we were just talking now, but you talked about that mortgage spread sort of being a little bit more persistently higher. Well, when the Fed's buying mortgages, they're a big buyer of mortgages. And when the Fed starts not buying mortgages as enough, that also can, impact the market rates. And it doesn't immediately snap on to whatever that new spread may be, right? Other buyers need to step in to absorb these bonds in the bond market, which is why they, it's extremely important for them to be very clear about their intentions and not surprise anybody. And if they said, hey, we're just thinking about maybe slowing the rate of which the runoff is being allowed, that's the first seed planted to just say, hey, just so nobody's surprised, we might think about slowing that down so that, to, again, try to orchestrate a soft landing as possible. And it's a new tool that they haven't really used until 2008, right? I mean, up until 2008, the Fed had a balance sheet, but your chart there, Paul, shows that it wasn't nearly utilized in the same way that it is now. And I think it's going to continue to be used as a tool to help manage, the long end of the yield curve, because up until, the financial crisis, they really only primarily used the overnight Fed funds rate as a tool. But when you get to zero, you don't really want to tell anybody, hey, we're all out of tools now. So they've developed a new tool for the toolbox, which I think they're going to continue to use, but also communicate, clearly about. So all I would say is they are very thoughtful about it, and it's helpful so that nobody gets shocked by any major change in policy, because they are a very big player in the markets.
And of course, they, as you pointed out, they only have a certain amount of ammo, and they sort of need to reload. They got to get the balance sheet down to where if they ever need to use it again, they'll have the ability to do that. I realize a bunch of questions have shown up on the Q&A thing, and we've reached an hour. So I know some of you have real jobs and have to actually go back to your office. I encourage you to contact. You're welcome to contact me directly. Contact the Mary or Leslie at the Economic Association if you want to follow up on the questions. I have copied all the questions that were in the Q&A and put them in a Word doc, and I will write some answers up and have Mary and send them around to Steve and Byron for insights, because I actually wanted to kind of pull back to the macro picture for Hawaii with just one more. So this is my try-wait slide, try-wait. So here's real GDP by state, pre and post-pandemic, for all 50 states and the District of Columbia. And I've re-indexed this, and you've seen this before. I used this, I think, last fall at the HEA conference. I center everybody on the end of 2019. So this is re-indexed. Fourth quarter 2019 is equal to 100. So everything thereafter, relative to 100, tells you in percentage terms. So for example, Florida and Idaho, the best performing states post-pandemic, have real GDP that's 15 to 20% higher than was true the moment before the pandemic. Hawaii's hasn't quite gotten back there. And if you look at the pre-pandemic era, right, because these are all relative to the end of 2019, the other states were coming up a lot faster into that 2019 benchmark than was Hawaii. Hawaii was kind of stagnant before. It's had a recovery that began to peter out a couple of years ago. And I just wonder if either of you want to, why did you come back, Steve? No, I'm kidding. But if either of you want to comment at all about we've been talking about big macro picture things, but none of it sounds very helpful to Hawaii. And which you can see, if you had a reason for why people are leaving Hawaii, this definitely could be it. So
okay, can I jump in on that? Can you show the one with all the states in it?
Yeah, absolutely.
So there's a couple things to remember. Yeah, so I actually did this graph the other day with payroll jobs. Looks the same. Hawaii's at the bottom with DC for some reason. Florida, and if you do payroll jobs Utah and
Idaho or somewhere.
Idaho are at the
Yeah.
top,
Yeah.
And so a couple things to remember. One is that part of this is due to population changes and therefore labor change, right? This is not per capita, this is total.
Correct.
Right?
No,
So
it's
one
absolutely
problem,
correct. Yeah.
one reason why
It doesn't
Hawaii,
get much better in per capita terms, Byron, but I
no,
take
it
your
doesn't.
point.
You're right. But part of it is population. So Hawaii's had a population basically that's been, on Oahu is still in decline, I think. And it's been very tepid on every island except the Big Island, right? So that's part of it. And then, of course, the other thing, and we've talked about this before, and so if you look at the ones at the top, those are also some of the highest population gaining states. So you gotta take that into account. The other thing, of course, and this is something we've worried about for years, is that we have a structural, our economy is structured in a way that it's a very low productivity growth state, right? We have this huge visitor industry. That's a huge service industry. Services are notoriously difficult to raise output per worker. And so we are going to have tepid per capita economic growth. And we always talk about diversification. Yeah, it's going to help on the margins to get some higher paying jobs in areas that aren't tied to tourism. But look, this is sort of the reality for Hawaii, I think.
Steve, I'll just ask you to chime in as somebody who did actually come back to Hawaii, came back from Zurich or Budapest or wherever it was you were chilling for 5 or 6 years. And I realize you've got family here and roots, obviously, and a great opportunity to work with some really great people. But just both from a personal as well as professional standpoint, because obviously a banking industry like others in Hawaii is going to reflect some of this relative performance. What do you see here, and can you offer any insights about where you think the future might be?
I guess I would only do maybe at this point some just anecdotal evidence. So when I left in October of 2018, working right downtown here, and again going out for lunch, walking up 4th Street Mall. There's a lot of restaurants, shops. HPU was still based up at that end of 4th Street Mall, and so it was a very vibrant feeling downtown area. Fast forward to now. Let's say not post-COVID, but later on in COVID. I don't know, does anybody come up with an appropriate term for that? Did we just say post-COVID? Anyway.
I'm trying to say post-pandemic, but yeah, I'm not sure anybody's buying it.
But it's a pretty dramatic change, just literally walking down 4th Street Mall now and just seeing, a lot of those lunch places closed. Obviously, a lot of office space now available in the downtown area that hadn't been. A lot of that office space is now being converted to residential condos, because there's still, as you point out, I recall regularly, there's still a huge housing demand and need here in the state of Hawaii. Is that that's at the margin probably not going to solve all of our housing issues, but it's just an indicator of maybe just some of the business activity that and just the downtown area and office space, and the change again since, call it 5.5 years ago, which I left pre-COVID. And so I think that's just maybe just an anecdotal, but a little bit of an evidence of maybe where that strength of the economy, and I think other downtown areas across the country and probably around the world are experiencing the same thing to some extent, right? Where the work from home is more of an option. And then, the office space, the restaurants, the businesses that all basically fed off of all of that downtown activity, are having a hard time. There's a lot of these small businesses, they're just not getting the same volume of downtown office workers. And so a lot of cities are, in this kind of pivot point of, okay, what do you do with your downtown areas, which used to be the highest property areas and, very difficult to get office space. And now there's an abundance of office space, and without an immediate clear sign that that's going to change anytime soon. So I use that as my comment back.
Again, I want to go ahead.
Just to follow up on that really quickly, Paul. I noticed when I was doing your chart with payroll data that it's not surprising that New York, the tri-state area, New York, New Jersey, Connecticut is below average as well. And that's probably a large part due to the office vacancy problem.
I have several slides that we won't use today, but I have tried to use in previous HEA presentations, talking about suburbs, exurbs, and Zoom towns, which is where the growth has radiated spatially out of these urban core environments. By the way, I met up yesterday with a commercial real estate broker who's done a lot of the office building deals downtown Honolulu. He's really high on Christine Kemp's acquisition of the Theo H. Davies Tower. I don't know if these are announced. We know about Theo H. Davies, Topa Tower, right? I think she's going to convert one of those to condos, maybe, maybe not. And then, the Liberty House, Walmart, all the way up to the McCandless building. I guess Christine bought the whole thing. So she's got big plans for what I think is a really interesting point that you raised, Steve, that we're sort of this moment where we've come to realize that remote work is here to stay, working from home is here to stay, as the paper title says. But that creates opportunity to do different things with the productive capacity. That's more of a meetup space than a sort of where you spend your day. And that to me raises two other final questions I just want to throw out there quickly. We're running out of time. Again, apologies to people. There was questions about consumer confidence. Seth asked about monetary policy with a lot of fixed, alternative sources of private credit. I think that's what Seth was asking about. I've copied those down. We'll see if we can do a little write up and post it on the HEA site. But along this theme of, being in transition, thinking new ways of doing, of new things to do with the productive capacity we have, two things that are striking to me. One, of course, is generative AI. I don't have any idea what to make of it. It just seems like this moment feels to me like 1994 when we coded BOH.com, when Sterling Nakano helped code BOH.com in hypertext markup language, when bank executives were telling us that the main uses of internet would be people looking for porn. I'm not making that up. And of course, now it's everywhere. But also the fact that we literally are doing this right now in a format that we couldn't have, 10 years ago, or, not with as much ease. And Byron was talking about social media channels like LinkedIn that have sort of evolved now to a space where there's a lot of sharing of information of rather, say, more serious nature content-wise. So can either of you maybe just comment on any of those things as we conclude here? I don't want to leave people with a downer,
So generative AI is the problem, right? Because nobody knows. I mean, if somebody tells you they know it's going to be like in 10 years, they're lying, right? So we don't know what it's going to amount to. We don't know. I think we all have a sense that it's going to make a difference and it's going to raise productivity a lot for some companies. And there's anecdotal stories about that already. And there's been estimates, that it could raise, GDP, 1% per year over the next decade or something like that, which awesome. would be just a complete game changer, right? But we don't know, right? We know there's some headwinds we're going to have to deal with, right? So we need to also remember that the labor force is aging. There's going to be very little labor force growth. If we don't have immigration, there'll be no labor force growth, right? Or it'll shrink. So there's those kind of things that are going to be pushing in the other direction.
Steve, any maybe where is financial innovation taking us? Seth implicitly talked about. I think he did asked about. I hear a lot about private credit, which is sort of like private equity. A decade or so ago, what's going on there? The non-bank, credit markets, or
yeah, I'm happy you brought up Christine's investments into downtown area. I didn't want to leave anybody with on a downer note. So it's actually really exciting that money's coming in to refresh that area. And I think I may have said pivot, so it's not all bad. We're just pivoting to a new use for the downtown area, but it doesn't happen overnight. And so that'll be exciting developments, I think, and maybe even an example of maybe where some other urban core areas could go around the country. So stay tuned on that. I think it'll be interesting to see how. It's always nice when Hawaii's leading the charge in some capacity or other that others can follow, and we don't highlight that enough. Actually, I would say as a state, because there are some great things we do.
I'm hoping there's a pied a terre with my name on it in downtown Honolulu.
So,
thanks, you guys. I think we'd better sign off here. I see Mary coming in to gong us. So thanks again for joining me, and thank you, Mary, and
Thanks for
the
having us.
association.
Thank you so much.
Yeah, thank you, guys.
What a great discussion with so much information. Thank you, Byron, Stephen, and Paul, for sharing your insights with us today. Before we conclude, let me just get my sharing here. Before we conclude, I'd like to mention our upcoming events. On a final note to assist, my apologies. Our upcoming event is April 18th, and that is the Impact and Future of Artificial Intelligence and Machine Learning in Hawaii. So registration is open. Please go ahead and register. We do have more webinars to come that are in the planning stages. And the big one that we do want you to keep an ear out for is our HEA annual conference on October 18th. So that will be coming towards the end of the year. And then let's see. On a final note, to assist HEA in planning and enhancing these webinars for you, please take a minute to complete the feedback form. Your input counts. We will send out an email with a link to this form along with any additional slides, as Paul was mentioning, or information that the speakers or panelists would like to provide. So please keep an eye out for that. So on behalf of the Hawaii Economic Association, mahalo for joining us today, and we'll see you next time. Thank you.